So I met an entrepreneur at the gathering Africa Eats Nairobi today, and she had a question about using impact finance to fund her business versus the expensive bank loans. And we worked it out on a piece of paper, and by the end, she came to a conclusion that was completely different than she'd thought before. And so I want to share that with you now. And even though we used paper, I'm going to use GPT. I'm going to dictate it and so you can see how you can use GPT to help you figure out business problems, right? I met a Tanzanian entrepreneur in the vegetable oil business who was trying to decide between using a 15% bank loan or a 5 to 10% impact finance loan. For context, she has a $200,000 factory which she can use as collateral to get a $100,000 loan from the bank. Get a purchase order for $160,000 three times per year, from which you'll earn 40% gross profit. The other alternative is that she uses impact finance at 5 to 10% interest, but it's going to take 1 to 2 years for her to get that money. Which one is she better off doing, and how much money will it cost her if she chooses the wrong choice? Okay, factory collateral 200K, loan amount 100K, impact loan 100K, but delayed by 1 to 2 years. Purchase order, okay, yep. Gross profit, yep. Correct. Option A, annual cost of loan $15,000, annual gross profit 192. After the bank, 177 per year. She can realize this profit immediately. Okay, not immediately, but the same year. Let's say option two. All right. So the profit will be a little bit more, 182 versus 177, but she misses out on 1 to 2 years of profit while waiting for the funding. The opportunity cost, if she misses 1 year, she misses out on $177,000. If she waits 2 years, she misses out on $354,000. Even with cheaper capital, the opportunity cost wipes out the benefit. This is something entrepreneurs usually miss. They see the interest rate of impact finance and think it's better than the bank. It's not. She's better taking off the bank loan immediately despite the higher interest, right? What you can do is, in 2 years, maybe she can get the impact finance to reduce the cost, but it doesn't really matter too much. So this demonstrates sometimes entrepreneurs, they think about reducing costs rather than increasing revenue. The thing about costs, they can only reduce down to zero. They're never going to go less. The revenue can increase infinitely, right? You can maybe there's the market size for vegetable oil is probably billions of dollars. So there's no limit as far as she's concerned, right? So she's much better off trying to increase revenue than try to decrease cost. In this case, because her profit margins are extremely healthy for her extremely healthy vegetable oil, that she is very much better off doing this now. The other thing is impact finance usually wants to see a track record. So if she does nothing for 2 years and tries to get this finance from impact investors, she's probably not going to get it. Whereas if she starts with the bank, maybe in 2 years, then she can reduce her costs with impact finance. So when she heard this, she was really clear on what she needed to do to grow her business. And so hopefully this helps you and this is something you can add. And yeah, if you're interested in raising capital and you want it fast, check out Kuzana, kuzana.co. We're accepting applications all the time.